The world is currently on a knife's edge in the Middle East. The conflict in Iran is entering its third month, having already paralyzed the Strait of Hormuz. In the tech world, the IMF is officially warning that AI is no longer just a productivity tool, but a systemic threat to global financial stability. And yet, if you look at the S&P 500, it's hitting record highs. Brent crude just took a 5% dive in a single morning, despite the geopolitical tension. If the world feels like it's falling apart, why does Wall Street look like it's throwing a party? The answer isn't world peace. The answer is a radical shift in how the global financial machine actually functions. Today, we're going behind the headlines to explore the great decoupling of 2026. We'll break down why algorithms have replaced earnings, how the oil market is being held hostage by peace rumors, and why your retirement account is currently being managed by a black box that doesn't care about the news. Let's start with the big one, Iran. As of early May, the US-Iran conflict remains at a dangerous stalemate, but the markets are reacting as if the ink is already dry on a peace deal. Oil prices, which peaked at over $120 a barrel earlier this year, have suddenly dipped below the $100 mark. Why? Because of narrative trading. Donald Trump's latest peace proposal and Tehran's hints about reopening the strait under new procedures have created a massive relief rally. But here's the reality check. Maritime data shows that transit through the strait is still down 90% from pre-war levels. Economically, we are seeing a massive split. In Europe, energy costs are triggering stagflation fears. In Asia, tech hubs are seeing record growth because the demand for AI chips is decoupling from the energy crisis. The market is no longer pricing in the war. It is pricing in the exit strategy. But if these peace talks fail, we're looking at a $250 barrel almost overnight. The volatility isn't a bug. It's a feature of 2026 finance, while the world watches the Middle East. A quieter and, perhaps more dangerous storm is brewing in Washington and Basel. This week, the IMF issued a startling warning. AI services and the latest large-scale models now pose a systemic threat to financial stability. For years, we've used AI to automate trading, but in 2026, the risk has changed. The IMF identifies 3 kill switches that could bring down the system. First, the cockroach problem. Private credit and AI-driven funds are now so opaque that we don't know where the risks are hidden until the whole kitchen is infested. Second, cross-sector contamination. Because finance, energy, and telecom now share the same AI foundations, a single hack can propagate a collapse across every industry simultaneously. Third, concentrated vulnerability. 80% of global trading is now handled by just a handful of AI models. If one model develops a hallucination about a market crash, the others will follow it off the cliff in milliseconds. This is why stocks go up when they should go down. The machines aren't reading the news, they're reading each other. If you're still waiting for a company to have a good quarter before you buy their stock, you're playing a 20th century game. In 2026, over 65% of all stock funds are held by passive indexers. This creates a feedback loop. The bigger a company gets, the more the index must buy it, regardless of its value. This is why US stocks are hitting all-time highs even as job cuts driven by AI. Efficiency are rising. We are living through the jobless growth era. Corporations are more profitable than ever because they've replaced labor with automation, and the market is rewarding that efficiency while ignoring the social cost. The decoupling of corporate health from human welfare is the defining financial trend of this year. We've entered a stage where the stock market is simply a reflection of capital efficiency, not economic health. So what is the takeaway for the savvy investor in May 2026? First, don't trade the headlines. The headlines are the narrative humans use to explain what the algorithms have already done hours before. Second, watch the Energy AI nexus. Energy security is the only thing that can truly break the AI growth cycle. And third, understand that volatility is the new stable. The stock market, we once knew the one about finding undervalued companies, and holding them for a decade is largely a memory. What's left is a giant real-time feedback loop of code and capital. If you want to survive, you have to stop looking at what the world is and start looking at what the machines think it will be. If you want more deep dives into the hidden mechanics of global finance, hit subscribe. We don't just follow the news, we follow the money. I'll see you in the next one.